So I think that's another thing that you got to watch is just this fragility that is endemic because of all these years of misguided monetary policies and this addiction to free money. I mean, I think Druckenmiller said that when money is cheap, people do dumb things. When money is cheap for 13 years, they do really, really dumb things. And we've seen a plethora of that, and all these speculative investments and all the other malinvestment that's gone on. And so now we're seeing that the payback for that. And I think personally, it's naive to believe that it's going to lead to a mild economic contraction. I just don't think that's the history of these huge bubbles.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. As we head into the start of summer, the U.S. economic outlook appears schizophrenic. GDP growth for the past 2 quarters has been positive, but gross domestic income has been negative over the same period. The multitude of macro data is screaming recession, yet earnings estimates are on the rise, unemployment remains low, and the stock market is booming. What can we expect from the second half of this year? For perspective, we turn to David Hay, co-founder and co-chief investment officer of Evergreen Gavekal, a financial advisory firm managing $3.5 billion of investor capital. And I love talking with experts like David because he's a steward of so much in assets under management that he can't simply rely on just having an opinion. He's got to steer his capital safely through what's coming next. So his conviction needs to be as high as possible. David, it's great to see you again. Thanks so much for coming back on the program.
Adam, it's a privilege. Thank you for inviting me back. And there's something to talk about.
Should have happened a long time sooner, but thanks for coming on. I'm glad our schedules worked out. Lots to talk about, like you said. If you don't mind, I'm going to kick this off with the general question I like to kick all these interviews off with. What's your current assessment of the global economy and financial markets?
Well, I think you brought up a very good point when you brought up GDI. I had no idea you were going to go there because that was one of the things that I did want to cover. And of course, that's talking about the U.S., not globally, but to look globally for a bit. I mean, if you look at China, there's been a lot of enthusiasm about the reopening. Yet they're actually getting another wave of COVID, and the reopening even before that's been disappointing. So you got to put that as under the column of not very robust. And then you've got Europe, which is back into a technical recession. Germany looks to be in a full-blown recession. So that's not too great. But there's definitely parts of the world that are doing pretty well. So it's a mixed bag. It's even a mixed bag in the United States. And there's a tremendous debate whether we are going to have a recession. More and more people seem to be even in the no landing camp, much less soft landing. But again, back to your GDI point, I do think that's an interesting one. I don't know if you've seen kind of the variation of that, the GDP plus, which is basically GDP and GDI blended together. Mm-hmm. And if you look at that, that is really, that has had a flawless record, and it's clearly screaming recession right now.
And I'm doing this from memory. I'll try to find a chart to put up here if I can find when we edit this. But I believe GD plus is negative the past 2 quarters. Is that true?
It is. That is true. And it's only done that when we've had recessions. So there's been no false negatives or false positives about a negative outcome, if you will. So it is meaningful, I believe. And just to kind of give a little more corroboration about that, remember last year we had 2 negative GDP quarters, first and second quarter. A lot of people thought we were already in recession. And I said at the time, even though I think one's coming, I didn't think we were actually in it. And GDI did not confirm that. So it gave a good signal at that point, too. So again, I think kudos to you for bringing that up because I do think that that's telling. And as you said in your intro, that there's just an awful lot of evidence out there right now that is screaming recession. And I mean, for one thing, the leading economic indicators have been negative for 13 straight months. That's pretty powerful. And then you got, of course, the yield curve, which has one of the best economic forecasting track records, and it's been inverted for over a year and deeply inverted. It's the biggest inversion, longest inversion we've seen since the early 1980s. So it's I think it's interesting to watch how kind of the group think oscillates around this theme of, are we going to have a recession? Are we not going to have a recession? Right now, the no recession is definitely dominant, but yet I look at a lot of data that's actually getting worse, not better. I think what we've had for sure is an earnings recession, which was my highest conviction call. I was less convicted on the actual recession, but now it appears pretty much certain we've got an industrial recession. So really the question is the consumer going to roll over? And I think that if you look at history, it's the manufacturing side that tends to lead the consumer side, because you start to get layoffs as these big employers start to have profit margin pressure. So they, what's their biggest cost? It's labor. So they start firing people, and then all of a sudden the consumer goes into the foxhole.
All right. Gosh, lots to tug into in there. And I got to be completely transparent with you. I just came to this interview having just finished an interview with Ed Yardeni, which will have launched on this channel the day before you. And Ed tells a much more sanguine story. And I was kind of prepared for that. I actually really enjoyed the discussion with Ed. It was the first time I interviewed him. And we've had a lot of people that have been relatively pessimistic on the macro data. Ed, like I said, is more sanguine on where things are going. And he doesn't doubt that we might not be in recession right now. But the way that he sort of described it is he sees it as being what he calls a rolling recession, where it kind of hits one sector of the economy and then moves to another as the other sector begins to recover. And so it's kind of like this baton getting passed laterally. He doesn't think we're necessarily going to see the entire economy sort of slump into a recession the way that, say, we did in 08 or in the tech sector in 01. I just thought it was an interesting way to think of it. You don't necessarily have to share that opinion or not, but I get the sense from what you're saying, you maybe expect more of the harder landing type, at least you don't expect a no landing type, which kind of is what Ed is suggesting by this rolling recession. That it doesn't mean we get off scot-free, but it just means that everything still kind of muddles through. I guess first, let me let you react to that. Then I want to get to your earnings recession, because I want to know if that's over or not, or if you consider just that may get worse.
Okay, well, let me first address the rolling recession. It's certainly possible. I think that would qualify as a soft landing kind of outcome. I think that's less likely than it was pre-banking crisis, because it's pretty obvious in looking at history that the worst economic periods are when you have a banking crisis. And I realize that a lot of people, probably the consensus view right now is the banking crisis is over. It was looking pretty scary a few months ago, or even a month ago, but it's subsided. And I think the question is, will it continue to subside? And I would just say that in that regard, the guy that has been the most accurate is Chris Whalen. He's was the loudest voice, one of the few voices really early in the year, saying, hey, this higher interest rate thing isn't necessarily good for the banking system. Mm-hmm. Because that was the view last year, is that higher interest rates are good for banks. And for a while it was, because they, of course, didn't raise the interest rates on deposits, right?
Right, they're making the spread.
They're still at unbelievably low levels. And people were just kind of brain dead. It was one of the big things I was writing about in my newsletter so much last year, was get your money out of a bank deposit and put it into some kind of money fund or a government security, somewhere you get a higher rate. And there was very little momentum to do that until the banking crisis hit. And then it was more of a fear factor than a greed factor, or not greed, but just, being a good steward of your money is, why let the bank, sit there. And we know people that had over $1 million sitting in the bank earning virtually nothing, when all it took was a phone call just to move it to the bank's government money fund. Yep. Anyway, so that is changing. And I think that's a big deal. And we'll have a visual you can run here on this topic, because there is a chart that people run that want to look at the stock market from a bullish perspective. And they say, look how much money is in money market funds. And it's true, it's going up radically. But what they don't say is look at bank deposits, because they're going down just as fast. So it's what I call the myth of the mountain of money, or the mountain money myth. And it's basically $1 trillion has come out of bank deposits and gone into money funds. So it really is just going forward, but it's the right way to go. I mean, it's smart for people to do that. And yet there's still many, many, many more trillions to go from bank accounts into money funds. Why does that matter so much? And I think it relates to the Ed Yardeni argument, because I think it has very negative implications for money velocity. Because as you well know, when money's in the banking system, it has a very high turnover rate. It's, could be 10 to 1 if there was enough demand for money. But once it goes into government securities, it's quite inert. So I think that is important, because you look at the money supply, which is contracting, and it's contracting for the first time since 1959. Now, the counter argument, I just listened to Stan Druckenmiller, who I would actually rate even higher than Ed Yardeni, and there's his macro abilities to forecast. And by the way, he thinks that we are likely in recession right now, and he's not buying the rolling recession argument. But his point is that, yes, there's still a ton of money, even though money supply is falling, it's falling from a very high level. So the overall stock of money is still quite elevated. And I think that there's truth to that. But it is falling. And now you've got this velocity issue, which it's kind of like monetary tightening, works with long and variable lags. And so I don't know how quickly this is going to bite. But I just know that historically, that if the banking crisis is not over, it's going to be hard to pull off this rolling recession, soft landing kind of scenario. And I think in general, that you've got a very fragile financial system with way too much debt. And I guess the other thing that I would argue against the Ed Yardeni situation is I think the odds of what I call the 4F scenario, which is basically a federal financing, fiscal financing fiasco in the second half of the year, is quite high. And it's because, part of this debt ceiling thing where they delayed the Treasury issuance and where they drew down their checking account, the Treasury general account. So that's got to be replenished. And also, which isn't getting much press, is that federal deficits are exploding. We ran $1 trillion deficit in the first half of this year. This fiscal year for the federal government was in September 30th. We'll probably have a $2 trillion full year deficit. And you've got that delayed financing that needs to be made up for. You've got foreign central banks, which used to be very active buyers of treasuries. Now they're sellers. They really don't want to hold treasury debt anymore. The banks have got obviously too much in the way of treasuries. It's killed them to have such a large treasury portfolio. It's unlikely they're going to be very aggressive buyers. So who's really going to step up and provide the financing that needs to be offered to the federal government, at least at interest rates, which are not severe? And right now, as you know, the short-term rates are 5, the longer-term rates are less than 4, but I don't see those longer-term rates staying there.
Okay. So first off, would you say the current rates are severe? 5% plus federal funds rate? Would you consider that severe given what the system can take, or would severe be even higher?
I wouldn't say it's severe. That's one of the conundrums, and we'll talk about this a little later, what looks attractive in terms of other securities besides treasuries, because normally at this stage of the economic cycle with a high risk of recession, inverted yield curve, just look historically, whenever the yield curve gets highly inverted, you want to extend duration. That's what I've done for my 44-year career up until now. This is the first time I'm not a duration bull, because I really am worried about this 4F scenario where the government just floods the market with more debt than can be acquired. And you create a potential for actually a failed treasury auction. I think that's a fairly high risk in the second half. So you've got kind of this, there is kind of a bias on Wall Street to be bullish and ignore these kind of macro threats. And generally that's the right thing to do. But I do think that when you listen to somebody like Druckenmiller, who says this is the most unsustainable situation he's seen in his career, and he's obviously had one of the most spectacular financial careers of all time. And then you've got Jeff Gundlach saying kind of the same thing, that $150 trillion of unfunded entitlements. Druckenmiller's actually saying $200 trillion of unfunded entitlements. Now, this stuff has been building for years, and it's never really hit a crescendo, right? We've always had the ability to kind of cover up the debt crisis with more debt, and the Fed has always been able to step in and be the buyer of sometimes first and last resort. I don't think that capability is there right now, at least when they're trying to fight inflation. So, you've got, I don't think I even mentioned it before, you've got the Fed selling instead of buying. So you've got a multi-trillion-dollar delta of this year versus a year ago or 2 years ago. And it just has a high potential to really be a crisis later this year.
Okay. God, there's so much I want to dig into here. I'm trying to make sure I don't lose these points because they're all good. So I asked my question about severe only because, what you were saying earlier was really talking to the higher cost of capital, right? That the economy is now burdened with, right? It was fairly addicted, I think is a fair term, to ZIRP policies or close to ZIRP. And we've gotten in a very short period of time to a much higher financing structure, right? I was curious your thoughts on, can the economy just sustain even where we are right now, let alone potentially go higher for the reasons that you just mentioned?
So because I really didn't address that, is it restrictive? With the Fed funds rate a little over 5, but the CPI was just reported today, core CPI running at 5.3%. So it's basically right at the Fed funds rate. Hard to call that restrictive. Now, if you look at, CPI, not core, it's in the 4s. And so you can say, well, it's at least a little bit positive. So much of this is, where do you think inflation really is, and where is it likely to be, to determine, are we restrictive? But you look at some of these emerging market countries where the policy rate is, way above the inflation rate. I mean, for example, in Brazil right now, the interest rate's about 14.75%, and inflation is, somewhere in the 4 to 5% range. I mean, that's like a Paul Volcker real interest rate.
Okay, yeah,
a lot of these emerging markets do have very significant real interest rates that now you would say that's restrictive. So it's hard to say that it's really that restrictive, but the problem is, and you were kind of touching on this, there was such a long period of interest rates gone missing that once they adjust even to what is not really a significant real interest rate level, if it is at all, but it's high in nominal terms, and these guys borrow in nominal money. Mm-hmm. So some of these weaker, lots of weaker corporations are going to be really struggling as they have to refinance, And some of these companies are just not going to make it. And it just all of a sudden, guess what's happening? You're seeing a spike in bankruptcies. Now, when companies go bankrupt, do they hire people or do they fire people? So I think that's another thing that you got to watch, is just this fragility that is endemic because of all these years of misguided monetary policies and this addiction to free money. I mean, I think Druckenmiller said that when money is cheap, people do dumb things. When money is cheap for 13 years, they do really, really dumb things. And we've seen a plethora of that, and all these speculative investments and all the other malinvestment that's gone on. And so now we're seeing that the payback for that. And I think personally, it's naive to believe that it's going to lead to a mild economic contraction. I just don't think that's the history of these huge bubbles.
Okay, great. I want to continue on that, and I want to both augment it and then present a counter, and then let you
sure
and what you think is right. So, Fed policy acts with a lag, right? And we've had a tremendously fast rise in the interest rate over a relatively short period of time, and everybody kind of has their own estimation of the time lag, but roughly a year sort of seems to be sort of in the middle of what I've heard people argue. I've heard people argue 9 months. I've heard people argue 2 years, but the point is that we still likely haven't seen the full force of many of the rate hikes that the Fed has made over the past year, right? Yes. And so we have those traveling through time, and they'll be slamming into the economy over the next couple of quarters, right? No matter what the Fed does from here, right? So I'm curious to hear what you think the impact of that's going to be, small, medium, large. But just to give you the counter next, and then you can react to all of it, is talking to Ed Yardeni. He talked a lot about the fiscal spending that's going on right now. So the monetary stimulus, that spigot's been turned off, right? So we're not doing QE anymore. We're doing QT. Interest rates have gone up. But there's still a lot of federal spending going on right now, from the Inflation Reduction Act and whatnot. And of course, now that the debt ceiling's resolved, the government's going to be able to technically borrow business as usual, at least until they get to a point where they have a failed auction that you're worried about. So we have that, and that's in the tune of trillions going on right now. And then he was talking about the boomers, that they're really at the point where they're hitting the age of retirement, and the boomers that have money are spending it. He said that there's 73 trillion in wealth amongst the 75 million baby boomers. And a lot of those guys are now done, and COVID's over, and they're coming out and they're spending. And that acts almost like a third stool of stimulus, right? There's the monetary, there's the fiscal, and then there's kind of the boomer spending. So I'll wrap that up and let you react to it. But on one hand, I can see the lag effects coming and saying, hey, David just mentioned a whole bunch of concerns, and this is going to make those even worse. But then do we have this other fiscal and boomer spending riding to the rescue here?
Yeah, great stuff. And certainly it's true that the boomers have an enormous amount of wealth. And, I'm a boomer. I'm right in the middle of the boomer, generation, born in 1955. So, yeah, it's true. And frankly, I guess I would take a little bit different, a longer term look at it. I think that could actually be the solution to our terrible fiscal status, because that money is going to get handed down over the next 10, 15 years to the next generation, right? It's going to be the biggest wealth transfer in history. And if America had a clue, our policymakers, they would say, hey, we've got a golden opportunity to put in some kind of effective estate tax that would create enough revenue to pay down in a meaningful way this massive amount of money that debt we've accumulated, plus all these unfunded entitlements. That could be a great solution. Now, that's, I know, a longer term thing. As far as on a near term basis, will that pool of money stimulate things? I think it's a confidence factor. Right? I mean, it certainly helps. But I think when people are scared, they tend to hunker down. And I think Americans in general are terrified about the course the country is on. And I think you can't just simply look at economics and say, well, really the economy is doing pretty well. I think that's highly debatable. Just if that was true, if all this money was out there and was being spent, why are retail sales so disappointing right now? I mean, the Johnson Red Book just came out. It's basically at zero. You're seeing a lot of high-profile retailers miss, companies that normally wouldn't, like Dollar General. And at first, it looked like companies were trading down, or consumers were trading down. The high end was suffering, and the consumer staples were doing fine. But even the consumer staples are looking soft. I mean, Campbell's Soup here recently had very disappointing volumes. Pricing is still strong. So I don't think you're actually seeing that type of scenario validated by activity right now. Now, I just think that's a lot of people don't want to spend their capital when they're scared. They tend to hunker down and spend less. And I think that's what you're saying. I just was reading, ironically, David Rosenberg. This is anecdotal, but he was talking about being on a trip this weekend to a very popular tourist spot in Canada by Niagara Falls. And he said, it's just dead. I think there's a shift going on. I think it's happening relatively quickly where, and maybe what you said earlier is the case, that this lagged effect of these higher interest rates. I mean, Mike Green, have you ever had Mike Green on?
Oh, absolutely. He's great. He's actually coming on in a week, I think.
Oh, really? Oh, cool.
Yeah.
Well, he'll hear him talk about this because he'll bring up, I'm sure, the auto loan thing. But basically, auto loan payments are up 90% from where they were in 2019. And his point is that as kind of this variable lag thing, as people now are buying more, new cars, which even though the new car sales rate is down, it's still about 15 million units a year. So eventually, these increased auto payments are going to be hitting more and more people, which he thinks is going to be a 6% hit to household disposable income. And as he points out, that's like the savings rate. It's a big, big number. What about mortgage payments? What's happened to those? Now you could say, well, people aren't buying homes, right? Because these mortgage payments are so high that and affordability, sucks. So home sales are, even though ironically the home builders are making new all-time highs, but lumber prices are down 77%. Well, it's because home sales are very sluggish, and there's just not going to be very, very many new homes built for a while. So the cost of housing is, for anybody buying a new home, is very, very elevated. So there's a lot of drags. Are there positives? Absolutely. The number one positive is how strong the labor market is currently.
I agree. I think everything hinges on that.
It does. But as we all know, or we should know, there's nothing more lagging than the jobs market. So what you have to do to get a sense of where is it headed is you have to look at the leading indicators of the jobs market, and initial claims is one of them. And initial claims all of a sudden isn't looking so good. In fact, 80% of states roughly right now have rising initial claims for unemployment. I think that's disturbing. You're seeing the quits rate go way down. You're seeing average hourly earnings fall. So some of these things that give us the Challenger layoff survey is surging, it's more than doubled over the last year. So lots and lots of straws in the wind. And that's why I have a hard time believing the optimistic scenario, though I will say that the economy's been more resilient than I expected. So you can say, well, look, Dave, you thought we'd be in recession by now. Well, we may be. Well, it's hard to know, as they backdate these things continually. But again, I've been worried for over a year, but for 13 months now, we've had falling leading economic indicators. I just think it takes a great leap of faith to ignore those, ignore the yield curve, ignore some of the GDP plus, so many of these things that have had reliable track records that are all flashing red, and say, no, this time's different. I mean, those are always dangerous words. You better have really good data to back it up. So I think the baby spending their capital might be a bit of a reach.
Okay. This is a fun interview for me because I tend to spend a lot of time right in the area you are, and I'm kind of throwing these bullish darts at you and watching you, do batting practice on them, which is it's super interesting.
Can I give you a bullish argument? Would that?
Well,
Can I give
please.
something
Yeah, yeah.
So one of
Absolutely.
the things that I think is surprisingly bullish, and this is more of a financial market aspect, but it certainly impacts the real economy, are credit spreads. Now, credit spreads, I think, are greatly underappreciated. I'm going to explain because it's a basic concept, but most people really don't track them. It's the difference between what corporations pay to borrow money and what the federal government pays to borrow money. And typically, when they widen drastically, it's a big red flag. Well, guess what? They did last year. So you had the kind of the deadly double whammy of rising interest rates and widening credit spreads. It's one reason why last year was such a brutal year. And for those that don't know it, it was the worst year for balanced portfolios since 1871 because people got hit on their bonds every bit as hard as they did on their stocks. And then, of course, if you were heavy in tech, which most people were, what the QQQ, the NASDAQ 100 was down 33% last year. It was a disaster. It's amazing, really, that people are as sanguine as they are after such a horrible year. But of course, now we're getting what I would call the echo bubble. And I think what's helping to sustain the echo bubble is that credit spreads have narrowed fairly significantly. They're at very non-alarming levels. So that's, if I was a bull, I'd say, hey, if things were really scary, Dave, why are credit spreads as calm as they are currently?
Yeah, and that's where I was going, which is things like credit spreads, things like analysts are beginning to increase. S&P forward earnings are actually being revised upwards right now. And we've had, a rollicking start to the market this year. So what's the deal?
But I think it's important to say that. I mean, I think we're all aware, we should be, that this market breadth absolutely stinks.
Sucks.
I mean,
Yeah,
it is
it's driven by
volatile.
stocks. Yeah.
And up through the end of May, the average stock was down. And a lot of the more cyclical companies were acting very recessionary. Now, again, to be fair, if you look at this month, it's like all of a sudden, and I actually just wrote this up this week, that, this belief that when you have very narrow breadth, that is automatically bearish. It could be a situation where the laggards catch up to the leaders. And that's what's actually happened this month. Small caps have come alive, and they were, just acting horribly up until recently. So, and that, if you wanted a historical corollary, look back to what happened from 2000 to 2002. You had a terrible, the NASDAQ went down almost 80% over that period of time. And yet there were some very powerful NASDAQ rallies, just like we're seeing right now. But then the downtrend resumed. But in the meantime, the value stocks, which had been so neglected in the late 90s, were in a bull market, despite the fact that we had a recession in 2001. Mm-hmm. So this belief that the value has to go down in a recession and growth has to do well certainly was disproved that time. And I would also argue that who suffers the most from higher interest rates, value stocks or high multiple tech stocks, which tend to be, the ultimate long duration assets. So I think I will admit, this is about as confusing a time as I've ever seen. And there are enough data points out there that are opposed to each other that you can kind of create whatever story you want.
All right, but it's so great to watch you explain kind of where you are focusing your attention, because as I said in the intro, you don't just have the luxury of opining and, if I'm wrong, I'm wrong. You're managing billions in client capital. So you've got to be making decisions based upon your convictions here. So if I'm summarizing correctly, on the net, you are more pessimistic about where things are likely to head from here, both in the economy and, if I'm intuiting correctly, on the markets as well.
Well, it depends on what part of the market. I think there's definitely opportunities in that we could see kind of the second act of the Great Rotation. I'm a believer the Great Rotation is happening.
Yep.
And, if you look at value, for example, last year, value held up. We got hammered for sure, but it held up much, much better than the NASDAQ 100. Now, this year, of course, we're getting a reversal of that. And the question is, does that continue? I think what's different this time versus, say, back in the 2000 to 2002 tech implosion was there was no AI. The internet was out there, but that had been out there for a number of years, whereas this AI thing has gone viral almost overnight. And that's obviously triggered a massive rally in the AI-related names. So that is different. And that's not something I saw coming. So it's, every time is different. And I think AI could be, a great driver of, say a renewed economic surge like we had in the 1990s. It could be great for productivity, and God knows we need it. If you're looking at these productivity numbers, they're horrific. They're the worst since 1948. We've had 5 straight quarters in productivity. We've got an aging society like America, which has a very sluggish labor force growth. If you have poor productivity, you've got really bad GDP numbers. mean, forget the short term, long term. So something's got to goose productivity, and AI certainly has the potential. Now, it could also create mass unemployment for a while. I think ultimately you'll get more job creation, but initially it could be pretty ugly. And what does that do? And this gets back to what, where Ardini was saying was that, hey, look, you've got all these deficits that Dave's worried about are actually bullish, because that's government spending, and that government spending without taxation, which is what happens when the deficits explode, it just falls, almost not directly, but it certainly enhances corporate profitability. But the problem is, normally that's true, but the problem is if there's so much debt that the government's got to finance, that it literally swamps the market. And that's what I keep saying, is that to me, if you run the numbers are very scary for the second half of this year when you have falling demand. And there's very few places, other than for short-term government securities, no problem. Lots and lots of demand for T-bills. So no problem. But I think where it gets really problematic is in the longer part of the Treasury market, where you could actually see drastically falling short rates and rising long rates, which of course would steepen the yield curve. Something's got to convert the yield curve from where it is now to more of a normal upward slope. That would do it. But that's not the happiest way to have it come about. So that's why I have a problem with this idea that all this fiscal stimulus is bullish.
Okay. And in terms of a steepening the yield curve because the long end is going up, do you think that is the more probable outcome right now?
I think it's certainly going to be sticky. I'd say a best case for the longer treasuries is they stay about where they are for a while. Now, ultimately, I think they've got to go significantly higher because I do think there's a realization that's starting to spread that is, I just listened to the second time this podcast with Druckenmiller that he did at the Sohn conference last month.
Great interview.
It was a good interview. And his point is that the math just doesn't work. And there's just not the buying power out there for the amount of debt that needs to be financed, and something's got to give. And as a result, obviously the U.S. can't default. So what's going to happen is the debt's going to get repaid. Actually, now what I'm thinking about is Ray Dalio. I just heard Ray Dalio interviewed on CNBC yesterday. He's singing basically from the same hymn book as Druckenmiller, saying it'll get repaid, but it's going to be with printing press money.
Yeah.
And that, to me, is critical that people, if the bond market is waking up to the fact that, yes, they will get repaid, but they're going to get paid in greatly depreciated dollars, then they say 3.75% on 10-year treasury is not enough compensation.
Right.
I want 6, I want 7, I want 8. Well, what does that do to the government's ability to pay that? I mean, as even Nikki Haley was saying on TV last night, that the government is now borrowing to pay its interest. I mean, that's the definition of a complete deadbeat.
That's a zombie nation. Yeah, exactly. We talk about
zombie nation. That's well said, Adam. It's a zombie nation.
God, so many great things there. I'm going to re-ask a question I asked earlier, just up a level when I talked about could the economy sustain the current cost of capital? Can the economy and perhaps even the nation sustain long-term rates like you're suggesting here? I mean, that is a world we haven't lived in a long time, and our debt levels are so much higher now. I mean, what was the national debt just going into 2008? Like, just 15 years ago, right? I mean, it was 9 trillion.
Probably 10 trillion. Yeah. So right at that
versus
now
31, 32 now.
Right. And again, that ignores all these off-balance sheet entitlements.
Exactly.
Which have grown exponentially. No,
So
the math doesn't work. You just have to say, I mean, to be a bull, you have to say, well, what you're worried about is down the road. It's not a clear and present danger. It's clear, but it's not present.
Mm-hmm.
I think it's becoming both. And it's because you just, again, look at the numbers objectively about how much money the government's got to raise, fresh money. Then, what's another amazing policy blunder. I mean, the Fed could have, or the Treasury could have basically termed out its debt when, extended maturities drastically when interest rates were so low in 2020. The 10-year fell to 0.5%.
Yeah, I mean, it should have.
Instead, 40% of the government's debt's going to roll over in the next 2 years.
Yeah.
So not only do you have all this new money that needs to be financed, you get this old money's got to be rolled over. Now, normally that's not a big deal, but if people start to get worried, and again, think that Ray Dalio is right, and when you hear Ray Dalio and Stan Druckenmiller, and like I said, they're kind of on the same page, it's like, I better pay attention. And, usually these kinds of macro concerns are not realized. And Druckenmiller's versus say he's been on this theme for 10 or 12 years, warning that this is just a disaster in the making. But at some point, it does. I mean, as they say, when the little boy was crying wolf, the wolf did eventually show up.
Yeah. Yeah.
But I guess the bigger point I'd make, Adam, is that, you look at the valuation of the stock market, it's very punchy. This is not a depressed, 2008, much less a 1974, 1982 type of market that's priced at 7 or 8 times earnings. And then you got the corporate bond market behaving like everything's fine. And even the fact that the Treasury can still sell long-term debt under 4%. I mean, that's just complacency. That's maybe the biggest bubble out there right now is complacency, despite you see all these, like Druckenmiller, I'm sorry to go back to it, but he's just had some great quotes lately that it's like people are sitting on the pier in Santa Monica and they're worried about this 10-foot wave that they can see offshore where there's a 200-foot tsunami lurking right over the horizon. And that tsunami it's headed our way.
All right. So I think you just sort of answered my question about, how can the economy nation handle these potentially higher yields we're talking about? And I think you're saying it can't. The math just doesn't work. There's some sort of reckoning that has to happen that certainly isn't being reflected right now in the pricing of the financial markets. They're just apparently way too sanguine for the type of concerns that we're talking about. And I guess it matters more how present the danger is versus clear, but it sounds like you think it is becoming both clear and present, and that's that maybe
it's a hazardous thing to say because it's like Buffett always says, say I think something is going to happen, but don't say when it's going to happen. And so I'm making the mistake of saying I think it could be the second half of this year. Now, actually, I hope I'm wrong. That's not something I'm looking forward to. That wouldn't be good for our portfolios, even though we're very defensively positioned right now. But I think you also, when into this complacency, look at the CNN fear and greed right now. It is, off the charts on the greedy side. Look at the inflows into tech. The largest inflows in a given week into tech just happened. And that's just more hard evidence of how bullish.
So I'm curious how you feel about the current action in this AI mania right now. I've had a couple of folks on. We've reminisced about how some of these valuations feel just as extreme, if not in certain cases, even more extreme than what we saw during the dot-com mania, right? We've got, what's NVIDIA trading at right now from a price to sales perspective?
Yeah, it's like 35 times sales, over 100 times earnings. Yeah, those are tough because it's like it can keep going. But at some point, it's going to get too far up, too extended, and it's going to correct hard. But with this AI thing, it's almost unquantifiable. It's kind of like when the cryptos were running, like you said, how high is too high for Bitcoin? Well,
right.
Nobody really knows. And when you don't know how big the market for AI is going to be, but I do think it wasn't that long ago that blockchain was kind of put in the same category as AI.
Right.
And that's, when's the last time you read an exciting story about blockchain?
Right. Or just where is a really concrete practical application of a commercial use of the blockchain that's creating lots of demonstrable profit today, like real revenues, real profit. And I'm not slamming the blockchain. I actually think it's a great transformative technology, and I think we will eventually get there. But your point is sometimes this takes just a lot longer to arrive than people expect, and so we pull in all this valuation to today that eventually has to kind of flow back out because, oh gosh, what we were expecting is not going to arrive for maybe a couple of decades.
Precisely. So it's getting overdone. I guess I'm reluctant to say, when is the point where you might want to really sell out of your NVIDIA, or if you're bold, go short. I'm just reluctant to do that. I think there's easier targets out there than NVIDIA. I've been there, done that. I think something like Tesla, for example, is getting pretty silly on the upside based on this charging station thing that was announced. But there's lots of excesses out there. Again, I believe it's an echo bubble, and so for those that are willing to buy puts or go short, I think there's some great opportunities, and I think you'll get some near-term rewards. But for the most part, I think what people need to know is that this is not a time, I don't believe, to be adding more capital to aggressive areas of the market. I think it's a time to be cashing in some of your profits and saying, thank you, Lord, that we've got this echo bubble, because it is rare that you get this second chance. So again, it did happen briefly during the 2001 decline in tech. There were a couple of very powerful counter-trend rallies. There were in the 30s even too.
And do you feel that probabilistically this is more likely that this is a bear market rally, meaning
Yes.
the bear market that started last year is not over, and as these things are wont to do, and they can be pretty violent in terms of they can be really big rallies, but they create a complacency that gets everybody off the sidelines, and then once everybody's back in the pool, the bear comes back out with his claws.
Precisely. Yes, I do think this is a powerful bear market rally, but that's all it is. And I think, frankly, what could be a balloon popper here is energy once again, because energy has been hammered over the last year. It was interesting. We were on last time. I was pretty bullish on energy. And ironically, or fortuitously, like the XLE went from, I think it was 70 when we talked last year, and it went up over 90. It's now about 81 or so. But oil's down $20 a barrel. And I mentioned Apache by name, and it was 32, it's 34, it's up a little bit. But, so the energy stocks, which actually last year finished up the year 56%, did amazingly well, better than oil did, because oil hit its crescendo at, 120 last spring 2022, then kind of double top in the summer. And it's been crushed.
Yeah,
way more than that. Way more. I never would have believed that we'd be under $70 a barrel with inventories at the kind of levels that they are right now. But, I guess you got to give credit to these SPR releases. It's they've released, it took them 25 years to build up as much oil as they've released in, a little over a year. Of course, not for any political reasons, right? It was all just to help the economy, which, a little bit of both, I guess, to be fair. Anyway, it's if we get another spike in energy, natural gas prices fell from 10 to 2. And I believe where you really got complacency is in Europe. I think they believe that they've got their energy situation solved. What happens? And I don't think this is improbable. What happens if that pipeline, that Russian pipeline that runs through Ukraine, gets taken out by either side or somebody else, but, or likely one of the two combatants? What does that do to the energy prices? I listened to a great podcast here recently where the very erudite gentleman was saying he's European, and he thinks that they're just way too sanguine that they've solved their energy crisis. So I think both natural gas and oil are going to have another spike, and I think it's going to shock people because there's such a big short position out there right now in oil. That's one reason it's been going down, not only the SPR sales, but also the hedge fund community that's just been pounding it. They're trend followers, and so they've been jumping on the bandwagon of the SPR. But when that short position has to be covered, it could be really explosive because the market is incredibly tight. I mean, it's basically you get the SPR at the lowest level it's been since 1983.
That's right. Okay, so you're not the first on the program recently to talk about the opportunity that's emerging in energy. If I had to sort of summarize the previous experts we've had, they've said it still could go down a bit further from here for some of the dynamics you mentioned and a few others, but they're entering at these prices, right? They plan to kind of dollar cost average continually on the way down. But they expect that it like it could actually be one of the better performers from here. I want to race through the rest of just your general market outlook, and I think we're well through it already. Where you think we're still in a bear market? Is it? I don't want to pressure you too much into a time frame, but looking around the end of this, well, let me put it this way. First off, I assume you think we're going to hit new bottoms at some point versus where we bottomed last year, correct?
Maybe. I think it'll at least be a retest of the June low, then followed by the October low, but which would be down a lot from here. Now, will it go to a lower low? Maybe it certainly could, but I wouldn't predict that.
Okay, but at least a retest. Okay.
Retest.
And would you expect that to happen, within this year, or would you rather have a little bit of a wider time horizon?
Well, yeah, that's a tough one. I suspect it would be this year. Not so much was going to depend on the recession. If we, as when you get corrections, when you have soft landings or just slowdowns or rolling recessions, to use Ed Yardeni's phrase, where you really get the major bear markets is when you get a recession, and not just an earnings recession, but a full-blown recession. So that's really the key. And I think a lot of the key to that is this banking crisis really over?
Mm-hmm.
And I don't think it is, but maybe I'm wrong. And if I am wrong, then I think that's going to be a big, big feather in Ed Yardeni's cap. But I think you look at commercial real estate. I mean, commercial real estate is a disaster, and especially office. I mean, you're starting to see more and more office building transactions at 20 and 30 cents on the dollar.
Right.
And
So that is a ticking time bomb that is just beginning to go off, basically.
yeah, there's $1.4 trillion of commercial real estate mortgage debt that's going to be rolling over in the next few years. Some of it's rolling over right now. And these lenders are terrified and they're starting to get jingle mail, the commercial equivalent of jingle mail, where they're getting the buildings back. They don't want the buildings back.
Yeah.
And
here's your hotel. I mean, no bank wants that.
Hotel. I mean, yeah, not just office buildings, hotels too, in at least some of these dying cities. And it's just, yeah, I mean, the macro situation is so different than the way the stock market's pricing things right now. But again, not just the stock market, the bond market too. And if I was really, I'd have more confidence about the timing that you were asking me about. If the credit spreads were going, north in a big way, as opposed to being so calm right now and sideways.
Okay, but that'll be a key indicator for you, right? When you start to see those spreads blowing out, you'll be saying, okay, look, probably the recession's coming sooner and a market correction, is coming. Okay, you're nodding as we're saying this. All right, so to the crux of what you do, manage capital, and once we get through this, there's an energy question. I'm still waiting to ask you if we can squeeze into the discussion here before the end.
Sure.
But you have to manage a ton of capital around this. So I've heard you say, okay, I think we're headed back downwards from here, right? Substantially, if we get to a retest of the lows. That right now is a good time to be selling into the strength. Maybe even look at it as a gift if you were down in 2022. This has been your salvation. You've recovered a lot of those losses. God answered your prayers. Get out, give thanks. And I've heard you say, okay, energy is you think that, look, it's not just completely go to cash. There's some value that's being uncovered right now, and that the general markets might come down, especially if the mega cap stocks correct, but some of these depressed value plays may actually go up, right? So you talked about energy as a sector that you're looking at. Are there any other areas where, as you are managing capital, what kind of key decisions are you making right now? What has your interest? What are you looking to get out of? I'm guessing you're looking to reduce bonds, or at least bond duration right now, given the concerns you have.
Yeah, we've been pretty short on duration. Let me address that one. Before I go off that, I did want to say one thing about energy, and why I think you're right about that is that right now the free cash flow yield on the energy sector is 14%. And that is there's just no other sector that's anywhere close to it. And if you get another run in oil prices, which I do think is coming, then it's, that's why I think you're going to have a tremendous pop in names like, I really should mention ticker symbols, but anyway, there's a lot of very depressed energy stocks out there right now that could really pop. But as far as the bond market and duration goes, it is a challenge. I think where you have an opportunity is maybe in the 3 to 5 year range with high grade treasury type of securities, or maybe even better mortgage-backed, government guaranteed mortgage-backed securities, because you're getting quite a nice spread over treasuries. Their duration's not too bad. They've got some decent convexity right now, which means that a lot of these things are trading at a discount from par, because normally with mortgage securities, as you're aware, the problem in a rallying market, assuming interest rates come down in that part of the yield curve, which I think they will, they don't really participate because they have the call feature. But when you get them deeply discounted, then you've got a decent amount of upside back up to par. So if it's 88 cents on the dollar, let's just say in general, kind of average on mortgage-backed securities right now, it could trade pretty quickly to par. So that's unusual. You don't usually get that yield pickup over treasuries plus the appreciation. Eventually, once they get to par, then you'll have that problem of lag participation on the upside. So kind of that short to intermediate part, I think, where you're going to get some benefit when the Fed starts to cut, plus you're locking in yields a bit. I think that's a decent place to be. We still like corporate bonds. There's a number, the largest copper producer in America right now, we do like copper very much long term. That's yielding about 6.4% on an 11-year bond. I think you get 6.4% and say, that's pretty good. I could live with that without having to bite your fingernails about the stock market. So there's definitely pockets of that. A number of these energy producers have bonds that are yielding in the 7 to 8% range. So that, and they're paying down debt rapidly. They're upgrade candidates. That's a good way to make money in the bond market. Identify those companies are going to go, say, from triple B, which is just below investment grade, to investment grade. Mm-hmm. I think there's some of the automakers, strong automakers in the U.S., where their debt's trading really cheap. You could kind of, there's not too many to pick from. There's a couple. I think they both look pretty attractive right now. As you can tell, I'm dancing around our compliance people who are.
I totally get that, exactly. So don't cross any lines that are going to get you.
Yeah, they don't like individual names. But I will say that Japan's fascinating. Japan's been one of my favorite markets. It's it concerns me in that it's hard to pick up financial publication these days or listen to CNBC without hearing somebody tout Japan. I never thought that would happen. I was such a lone ranger for so long with Japan, but it had a major breakout. As you know, I'm a believer in range expansions. When a stock market or a sector or a stock breaks out of at least a 3-year trading range, that's a very significant development in our world. And it is amazing when you look at the individual Japanese securities, how many of them are breaking out either to all-time new highs or at least multi-year highs. So Japan looks very interesting, though I would like to see it pull back a bit. It's had quite the run here lately. Same thing with uranium. I think uranium, because of this nuclear renaissance, is really going to have a major up move. It's run lately, so I'd be a little careful about chasing it right now. But I know we're going to talk nuclear here at some point, but I think that's one of the most exciting stories, not just for investment plays, but for mankind. And I think if you got a nuclear renaissance, which is I think underway, combined with AI, you could create a very bullish story for the next 10 years.
All right, well, let's go straight to uranium from there. That's the best setup you could have. So I'd meant to leave a little bit more time for this, but sadly, you just gave me so many interesting things to react to that we're maybe cramming it in here a little bit at the end. We're going to drive people to a video that really dives deep into this topic. And David, we can obviously have you back on again anytime you want to dig more, flesh this out more fully. But why don't you, if you can, really quickly just kind of expound a little bit on why you think nuclear's opportunity is really arriving right now. And in terms of investing in it, you mentioned uranium. Is the best way to play it by buying these uranium trusts, like the actual metal itself, or are you or mineral itself, or is it better playing mining companies, or are there even better plays in this space?
Well, it's a great question. The problem with the miners, and I think there will be times where this won't be true, but right now they're pretty pricey. At least kind of the leading blue chip play, which we've made good money on in the past, is outside of our buy zone. So it's kind of a weird thing where you had the price of uranium quite depressed and the price of the miner, the leading miner for it, quite elevated. But now uranium's starting to come. So I think for right now, the metal's the play. The other way to do it, which is definitely more difficult and adventurous, is to identify those companies that are developing this next generation nuclear technology, because that's really the gist of this whole issue, is that we're now moving away from light water reactors, particularly in the United States. It's just unbelievably expensive to build these huge, 1,000 megawatt plants. Like finally in Georgia, the 2 Vogtle plants are coming online, but it's taken them decades, and they're billions and billions of dollars over budget. And that's just the problem in the West, is that when you've had some of these nuclear accidents, whether it was 3 Mile Island or Chernobyl, or of course Fukushima in 2011, which really set the nuclear industry back, what happens is the regulatory authorities then start designing in all these protections, these triple, quadruple, quintuple redundancies to make sure that you can't have a major nuclear accident. And so it just makes nuclear power unaffordable, not just from a cost standpoint, but from a time standpoint. So fortunately, in the nick of time, we've got these small modular reactors that have been under development for many, many years that are finally getting, they're going to prime time with government support. And I think that's the key thing, is governments, which were basically apathetic, if not, had antipathy towards these small modular reactors, are now getting behind them. And there's a significant amount of money being released from the IRA, the Inflation Reduction Act, funny name, to small modular reactor development. And what's really interesting within that are molten salt reactors. And I'm actually in the process of reading a book written by the father, really, of nuclear power generation in America, or certainly one of them, Alvin Weinberg. So he's from Oak Ridge National Lab in Tennessee, and they developed molten salt nuclear reactor technology in the 60s. And it ran for years and years and years, and it ran flawlessly. And it's a walk-away safe approach. And a company that I'm an investor in, again, I'm not recommending this to your listeners because it's very high risk. They don't have a single order yet. If they get an order, that's going to change things drastically, particularly if it's from one of the major nuclear labs. I won't mention any names there, but they're close. But I do think somebody's going to, because really the technology was already proven. And this Alvin Weinberg was just a brilliant man and he was very concerned about light water reactors not being as safe as they were supposed to be. But he got outmaneuvered by Nixon, because Nixon was from California. A lot of the light water reactor technology was being developed in Southern California. And Chet Hollifield, another very powerful California politician. And so he got the squeeze play. He was on the wrong end of the squeeze play. And unfortunately, we didn't develop molten salt reactor technology for the last 50 years. But I think that's changing. It should have changed a long time ago, but it's very impressive stuff. And you mentioned the video. There is a good video that was created by Micronuclear, the company that I mentioned. And again, I'm not sure that these guys can pull it off. There's a lot of things that could go wrong from a regulatory standpoint, but somebody's going to do it. And I think that the answer is going to be molten salt. There's a guy named Adam Rodman who's a genius, brilliant guy. You can go to the Macro Voices website. You can hear some of his interviews. He's not an investor in Micronuclear, but he really believes molten salt is the wave of the future.
There's a whole bunch of benefits of molten salt fuels, and I honestly need to brush up to remember all of them. But when I remember, this was described in the context of thorium, which I know we don't really have any working thorium reactors right now. I don't know, it may be true with uranium, but one of the quote unquote safety benefits there was that if you ever did have a core breach, the molten salt would just drop out and it would cool and it would just harden. And then you could literally pick it up, put it back in a repaired core and heat it back up again. So you didn't have to worry about these sort of, core meltdowns that just sort of melt to the center of the earth, basically.
You're exactly right. No, that's true. And it is a huge advantage. The other thing that's interesting too, and if your viewers listen to this podcast that I did about 10 days ago with Doomberg, who's pretty well known in our industry, and then my friend who's this nuclear energy expert, he's been in the nuclear power business since the mid-60s. He was a Navy nuke guy under Rickover, and a lot of the people that are involved with this company are former Navy nukes. And, that's the thing is that Navy has been using nuclear propulsion safely for, 60 years. Mm-hmm. And, why can't we figure out how to use that in civilian applications? Now, frankly, they don't use molten salt. Rickover, who again was father of the nuclear Navy, was a big light water guy, but they are smaller reactors. And, one of the advantages of these things is because what kills these light water reactors is that, especially in the United States, they're all customized. Russia and China don't do it that way. They use more standardized designs for their light water reactors. But with these smaller ones, you can literally do an assembly line type of production for them.
Right.
So that's a huge advantage. And it's also, they can be distributed power sources, because one of the greatest problems that we're going to have with what I call the great green energy transition is the grid. The grid is already, very fragile. It's going to get more fragile as we introduce millions of more EVs that have to charge off the grid. The battle over transmission lines is absolutely, it's intense, unbelievably intense to get new transmission lines built. So if you can put these small modular reactors, where you need the power, where you don't have to rely on long distance transmission lines, that's a big advantage. The other thing is, as my Navy nuke buddy says, is that we look at our nuclear waste that we have already, which we can't for some reason put at Yucca, but we have it. It's not stored as safely as it would be if it was at Yucca. But he says it's not a liability, it's an asset, because with these small modular reactors, you can use that. You can recycle that nuclear waste and put it in the molten salt reactor. So nobody really ever accuses me of being a starry-eyed optimist, but I really think that this technology is ready to go viral. And it could be, in its own way, in the energy world, almost like what happened with ChatGPT.
So a couple of things. One, the immediate resistance you always run into when you talk about nuclear is safety, right? Safety of the reactors themselves, and then safety issues around the waste. And rather than try to summarize that into just a pithy sentence or two, which isn't going to convince anybody, the last interview I did on nuclear with Doomberg, we really dive into this deeply, as I did the same thing in my interview with Justin Hune, who's the publisher of Uranium Insider. And so if you're having trouble kind of getting on board this train that David's talking about because of those concerns, just go listen to those videos. You'll at least hear the detailed rationale for why the risks are potentially far lower than the public's perception of them. David, you talked about something that I think is really important and maybe not super well understood, is that pretty much every nuclear reactor that's been built in the US so far has been a one-off, right? And so from a design and a construction standpoint, it's an experiment, right? It's the first time doing this. You got to go through all these local laws, and everybody puts their own little, twist on it. And you talked about the multiple redundancies that are being put on now, right? So if you have a modular approach, one, you get tremendous economies of scale. These things get much more cheap to build and to operate because everything is standardized. It also makes, presumably, I think, the red tape, especially at the federal level, a lot easier to cut through because folks know exactly what they're dealing with. You don't have to explain every single new design to them every time around. Also, the light water nuclear reactors we have right now, they're massive. And so you're limited of where one can go because you need to have the water sources and have all the environmental studies done. And these things, can have big environmental impacts in their construction or their safety zones. They have to buffer around them. When you get to these smaller reactors, everything gets easier. You can put them in way more places. You can put them closer to population centers. They don't have to be dependent on massive, rivers or oceans. And so there's just, what you're talking about is if we can unlock this new type of design, there's just tremendous deployment opportunity out there. You're nodding as I'm saying all this. Am I describing this correctly?
You're doing great. I couldn't disagree with the thing that you said, although I would add, again, think of the grid. That if you can avoid being reliant on the grid, because it's just, remember how what big deal in computing was distributed computing? Well, this is like distributed power. So it's, right. I do think it is a game changer. I know that's an overused phrase, but I do believe it is. So yes, I think that's good. So I would also say anybody that's really interested in this, Google Alvin Weinberg. Just go back and read about this guy and read about how he got bushwhacked, frankly, by Dixon and some of the other powerful California folks. And it's, I'm not a fan of Nixon because of what he did with the gold standard. But as I read more into this story, it's like, he was just doing what politicians do. He's trying to get jobs into California. But still, it was unfortunately a terrible decision for the country and one that Alvin Weinberg was able to foresee. So he's quite a guy. And other than that, I guess, be sure to, if anybody's interested, be sure to access that link to that video. I know you can also go to our Substack site and you can go to the end of the timestamps and it's there as well. But I think you're going to put a link up so people can access it easier.
I am. If you want to go watch this video that David's talking about, the one of him and Duberg and the nuclear expert, which I highly, highly recommend everybody go watch after this video, just go to wealthion.com/SMR and you can go watch it there for free. David, great discussion. It's a fascinating topic. It's one I really do look forward to having you back on to get more deeply into the opportunities that are going to be unlocked by this. Because look, huge fan of renewable energy sources, right? We should do wind and solar when it makes sense. The thing just to consider, though, is that throughout human history, we've always moved from a less dense energy source to a more dense one. Renewables are actually a step backwards. They're a less dense energy source. And, to really try to make up for the capacity that we'd be losing by trying to wean ourselves off of hydrocarbons, just the footprints and the amount of materials that we need to be mined to create all of the solar farms and all the wind farms, even if they worked perfectly, even if we put aside the fact that there's intermittency in both of those, they just become tremendous, right? Where nuclear is so concentrated, it's so much denser. It's such a better option on so many of the different metrics that we look at. I look forward to.
Can I just say amen, brother? That was a great sermon, and I totally agree with what you just said.
Okay.
Yeah, you said when they make sense, wind and solar when they make sense, but you're exactly right. That's a point that I made repeatedly about the great green energy transition. That's moving from high density to low density. It's just contrary to human civilization, and this is a way that we can achieve the desirable outcomes we're looking for without doing that.
Well, exactly. And we're learning this, right? The challenges of our current policy and our current trajectory in Germany right now, right? Where, they for green reasons and you can laud their intentions, but they really overinvested in wind and solar and they decommissioned their nuclear fleet. And then we had last year happen and they basically ended up burning more coal than I think they'd ever burned the previous year.
Wood, which is even dirtier than coal. They burn, I forget, something like 15% of their electricity now comes from burning wood, which mostly comes from the United States. And There's real controversy about the forests that are being cut down to supply that, including out of Eastern Europe, not just the U.S. Yeah, so coal usage worldwide is increasing, and Asia in particular is really in a dramatic build out of coal plants right now, both China, India, Indonesia. So it's that's really the sad thing about this, is that in some ways, by prematurely trying to get to the renewable power sources, we are actually hurting the environment. So we need a break. We need a breakthrough, and I think this can be it.
All right. Well, look, reminder, folks, please go to wealthion.com/SMR to watch that video after this one. David, fantastic discussion. Wonderful having you back on the program. Thanks for coming back on. For folks that want to follow you and your work, where should they go?
Well, you can kind of see that behind me here, the Haymaker at Substack. So it is Substack. We're a Substacker. So yes, do go to that and sign up. Our newsletter is free. So it's something that I think will benefit anybody that cares about the financial markets. We tend to be contrarian, but I think we, for one thing, Adam, like you, I've got so many people that I respect. I've quoted a number of them today. My Rolodex, digital Rolodex is, I'm just very, very blessed to know as many people as I do that are far smarter than I am, and I try to convey their thoughts to my readers.
And as a subscriber to your Substack, I can personally vouch that it's a phenomenal asset. The fact that it's free is almost criminal. But definitely, if you've enjoyed this discussion with David, I recommend everybody go subscribe to that right now. Okay, well, in wrapping up here, David just did a phenomenal job of describing all the cross currents. And as he said, he's a highly experienced capital manager, and this may be the most challenging time that he can remember, trying to figure out how to, intelligently and prudently navigate capital through what's going on right now. So highly recommend, as usual, that you navigate this using the guidance of a good professional financial advisor who understands all the macro issues that David and I talked about, and is using that insight to create a personalized portfolio plan for you and your wealth, but then executing it for you and keeping you informed along the way. If you have a good one who's doing that, excellent. Stick with them. Definitely, they are very rare and worth their weight in gold. But if you don't, or you'd like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors endorsed by Wealthion. To do so, just go fill out the short form at wealthion.com. Only takes you a couple of seconds to do so. These consultations, again, are totally free. They don't cost you anything. There's no commitment to work with these advisors. It's just a free public service they offer to help as many people as possible position prudently now in advance of some of the things that David said may be coming. With that being said, if you'd like to see David come back on this program again in the future, please help encourage him by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. David, it's been wonderful, my friend. Thanks so much for giving us so much of your time today.
Thank you, Adam. I really appreciate it. Look forward to it next time.
Thanks. Everyone else, thanks so much for watching.